How I'd build $700 per month in passive income as an Australian. What if your investment portfolio paid you $700 every single month? While you slept, while you worked, while you did literally anything else. $700 a month is $8,400 a year. That's your electricity bill, groceries for months, or a return flight to Europe. Covered entirely by passive income. Today, I'm going to show you the exact step-by-step blueprint I would follow to build $700 per month in passive income as an Australian in 2026. Real ETFs, real numbers, real timeline, and the best part, you don't need to be rich to start. What is passive income and what it isn't? Before we get into the strategy, let me clear something up because there's a lot of confusion about this. Passive income doesn't mean income for doing nothing from day one. You have to build the asset first. The passive part comes later. For most Australians, the most realistic and accessible form of passive income is dividend income from ETFs, exchange-traded funds listed on the ASX that pay you regular cash distributions just for holding them. You put money in. The ETF holds dozens of Australia's biggest companies. Those companies pay dividends. The ETF passes those dividends to you quarterly or even monthly. No stock picking, no active management, no stress. You just hold and collect. The maths. How much do you actually need? Let's work backwards from the goal. $700 per month equals $8,400 per year in passive income. The key number we need is the dividend yield. That's how much income an ETF pays you as a percentage of what you've invested. VHY, the Vanguard Australian Shares. High yield ETF currently has a dividend yield of 5.37% and paid $4.57 per share in distributions over the past year. So at a 5.37% yield, here's the simple maths. $8,400 divided by 5.37% equals approximately $156,000 invested. That's the portfolio size needed to generate $700 per month from VHY at its current yield. Now I know what you're thinking. $156,000 is a lot. But here's the key insight. You don't need to get there overnight. You build toward it, and the dividend income you earn along the way gets reinvested to accelerate the process. Let me show you what that actually looks like with realistic timelines. The 3 ETF blueprint. Here's the exact portfolio structure I'd build. 3 ETFs. Each plays a different role. ETF 1. VHY. The core income engine. 60% of portfolio. VHY Vanguard Australian Shares. High yield. ETF is the foundation. VHY remains the largest dividend ETF in Australia, with almost $7 billion in funds under management. It holds around 76 of Australia's biggest dividend-paying companies: CBA, BHP, Wesfarmers, NAB, and pays distributions quarterly. The most recent VHY distribution included 72.17% franking, meaning a significant portion of the income comes with franking credits attached, which can reduce your tax bill or even generate a refund at tax time. Fee: just 0.25% per year. Current yield: around 5.3 to 5.5%. This is the backbone of the whole strategy. ETF 2. HVST, the monthly income booster, 25% of portfolio. VHY pays quarterly, which means 4 payments a year. If you want smoother, more frequent cash flow, you need HVST. HVST, the BetaShares Australian Dividend Harvester, is actively managed and pays distributions monthly, making it especially attractive for investors who want regular cash flow. It typically holds 40 to 60 ASX shares, focusing on highly franked dividend payers including NAB and Wesfarmers. The trade-off? Higher fees than VHY at around 0.90%, and it's actively managed so performance can vary year to year. That's why I'd use it as a complement to VHY, not the whole portfolio. ETF 3. VGS or VIHY, the global growth layer, 15% of portfolio. VHY and HVST are both heavily Australian banks, resources, and financials. That's a lot of concentration in one market. Adding a global component reduces that risk. In 2026, Vanguard launched the Vanguard International Shares High Yield ETF, ASX VIHY, which focuses specifically on high-yielding international shares, offering investors an income-focused approach to international diversification. Alternatively, plain VGS gives you global growth with lower yield useful if you're still in the accumulation phase and care more about total return than immediate income. At 15% of the portfolio, this layer adds diversification without diluting the income strategy too much. The realistic timeline. So, when can you realistically hit $700 a month? Here's what it looks like at different investment amounts. If you invest $700 per month, which is poetic, right? At a blended 5.3% yield, year, portfolio value, monthly passive income, year 1, $8,800, $39 monthly. Year 3, $29,000, $128 monthly. Year 5, $52,000, $230 monthly. Year 8, $90,000, $398 monthly. Year 10, $120,000, $530 monthly. Year 12, $156,000, $700 monthly. If you invest $1,500 per month, you hit $700 per month passive income in roughly 7 years. If you invest $2,500 per month, you get there in about 5 years. The key variable that people underestimate, reinvesting your dividends in the early years. Every quarterly payment you reinvest buys more units, which pays more dividends, which buys more units. That compounding snowball is what makes the timeline realistic. How to actually start step by step. Here's the exact process to get started this week. Step 1. Open a brokerage account. Platforms like Stake, CommSec, or Perla all allow you to buy ASX ETFs. Perla is particularly popular for passive, long-term dividend investors. It even has automatic investing features. Step 2. Start with VHY first, even $500 to $1,000 to begin. Don't wait until you have a big enough amount. Time in the market beats timing the market every single time. Step 3. Set up automatic investing. Most platforms let you set a recurring buy, for example, $500 every fortnight into VHY. This is dollar cost averaging. You buy more units when prices are low and fewer when they're high. automatically, without thinking about it. Step 4. Turn on dividend reinvestment, DRIP, in the early years. Don't take the cash yet. Let every distribution buy more units. This is the compounding engine that builds your portfolio faster than any other single action. Step 5. Add HVST and VIHY once your VHY holding is established. Once you have $10,000 plus in VHY, start layering in the other 2 ETFs to diversify and smooth your income. Step 6. Track and stay the course. Apps like ShareSite make tracking your dividend income dead simple. The most important thing after setup is simply not panicking when markets drop, and keeping your automatic investments running regardless. The honest reality check. I want to be honest with you before I wrap up. Building $700 a month in passive income takes time. Years, not months. Anyone telling you otherwise is selling something. Markets will go down. Your portfolio value will drop sometimes, and that can feel scary. But as long as the underlying companies keep paying dividends, and Australia's big banks and miners have done so through recessions, pandemics, and rate hikes, your passive income keeps flowing even when prices drop. The discipline is in the consistency. Invest regularly, reinvest early, stay the course. The income follows. Drop a comment below. What's your passive income goal per month? $300? $500? $700? $2,000? I'd love to know from where you're aiming. And if you've been watching this whole series, I've now covered everything from VAS versus VGS to superannuation strategy, mortgage versus investing, why Australians can't save. And now this. If any of these videos helped you, subscribing is genuinely the best way to support the channel. Hit the subscribe button, turn on notifications, and I'll see you next Thursday.